Hello and welcome to this month's webcast on Latin America. I'm Haley Reed, and today I'm joined by Federico Filippini, Numera's senior macro strategist. Federico will discuss our latest views on Latin American monetary policy, inflation, and exchange rates. Using the information derived from Numera's proprietary models, he will also make recommendations for equity and bond investments over the coming year. Using the Q&A feature, we encourage you to write any questions you may have for Federico, and we will try to address them at the end of the session. Also, note that later today, we will send you a copy of this slide deck as well as a recording of the webcast. But before we dive in, I would like to give you a brief overview of our unique approach to macro research. Unlike conventional macro shops, we don't just focus on central scenarios, but evaluate the full range of potential outcomes. We do so because outperforming the markets requires properly estimating the uncertainty behind expected returns. It's really all about identifying favorable odds through the power of probability analysis. In practice, we rely on cutting-edge probability forecast models to help clients quantify the upside and downside risks faced by their investments. The approach helps monitor extreme events and uncover opportunities often missed by financial markets, giving our clients the ability to capture additional alpha. This chart shows our 12-month projection for US equity returns. Stock returns are subject to multiple shocks, so focusing solely on expected returns ignores the true risks faced by investors, which may either result in significant losses or even undermine investment opportunities. With the information derived from our distributions, we then take it one step further and translate these signals into actionable investment recommendations. This is much different from our industry peers who tend to form their opinions based on gut feeling rather than science. This table is a scorecard of some of the recommendations we've made over the past year and the returns you would have experienced if you had followed the signals produced by our models. One of our strongest calls was the one we made on oil at this time last year. Our models revealed a very high probability of prices rising above $80 per barrel by October 2021. This was much different from what financial markets were expecting, which was for oil to remain below $50. Fast forward 1 year, and investors who followed our recommendation to overweight oil would have made nearly a 100% return. All to say, our models give us the tools to anticipate changes in concepts that are notoriously difficult to forecast with standard methods. Numera clients receive over 100 research reports per year, covering multiple economic and investment themes. We draw information from our proprietary models to provide forecasts on all major asset classes such as equities, bonds, commodities, and foreign exchange. We also strive to expand our scope continuously, offering in-depth analysis on global, US, and Latin American markets. This takes me to the idea for today's webcast, which is to present to you our latest views from our new economics and strategy service for Latin America. The service was launched in September and is led by today's presenter, Federico Filippini. He is supported by our talented team of economists and strategists in Argentina who have vast knowledge about markets and policymaking in the region. Apart from our accomplished team of economists in Argentina, we also have a team at Numera's headquarters in Montreal, Canada. So I'm now going to pass it on to Federico for our latest outlook and recommendations for Latin America.
Thank you, Haley. Hello, I'm Federico Filippini, Senior Macro Strategist at Numera, and today I'll be talking about Latin American macro and investment outlook. Latin America is recovering from the COVID crisis. The initial rebound is now transitioning to some softening of the activity, mostly across the region. In this chart, we are showing our proprietary high-frequency real activity index for Latin America and Brazil, which shows a deceleration that has been particularly sharp in Brazil. Note that what we are showing here is the deviation from the trend for each of the series to highlight the synchronization of both variables, but crucially, what we are showing here is that in the last 2 months, the activity has been surprisingly negative. Keep in mind that we are comparing to a slow trend. In particular, the trend that we are using here is around 1.5% for Brazil and around 2.2% for Latin America. So implicitly, this chart also shows the performance of Latin America over the last decade, which has been another lost decade for Latin America when we compare to some other EM's regions. This also reflects the fact that there are many structural problems which will continue to weigh on growth in the medium term. We have discussed many of these structural issues in our global macro strategies of July, which concludes that we might be starting another decade of subpar growth for the region. Apart from the impact of the COVID, which has dragged the economy, we also see a highly uneven recovery, highlighting the importance of domestic factors as a major source of risk. Vaccination rates has been steadily rising, and mortality rates has been progressively under control at last in the region. This chart shows our estimate for the herd immunity, calculated in terms of months required to the immunization of 85% of the population, given the current vaccination rates and infection rates in the region and globally. Clearly, Latin America has had a slow start in the vaccination rates that can be dated somewhere in the second quarter of 2021. Yet, in terms of immunity, the region currently fares quite well as it benefited from the high natural immunity produced by the sharp 2020 and early 2021 acceleration of cases in the region, taking into consideration that the region accounts for around 1/4 of all COVID-related deaths worldwide, while making only up to 8% of the global population. To be clear, the current immunity in Latin America is comparable to that in developed markets, which means that the impact of the Delta variant, whenever it happens, should have a relative minor impact in terms of death and also in terms of activity, which is a positive note that comes at odds of several additional factors. Take into, for example, the impact of terms of trade. Terms of trade, while deteriorating at the margin, has been very beneficial for the region over the last 18 months or so, with the exception of clearly Mexico. This chart shows the 4 months moving average of the terms of trade standardized around the 2009-2019 average, which is indexed to 100. So, for instance, take the example of Chile. Chile terms of trade now stands around 28% above the 2009-2019 average and close to 10% increase year-on-year. So what prevented the region from benefiting from the exceptional international context? It is not just the terms of trade that benefited the region, but also we have to take into consideration the persistently low interest rate in developed markets that typically encourage capital flows into the region and boost investment. As we mentioned above, public health risk was indeed a key drag, but also there are many additional factors, in particular domestic factors. Some of those factors are the political strife that the region faces during the challenging electoral calendar. But turning back to the terms of trade, the impact of this domestic factor have significantly affected FX. Currencies in the region are moving away from the terms of trade, decoupling from the co-integrating relationship that they displayed over the last decade. Indeed, we think that currencies are trading below fair value, in particular in Brazil and across several of the Indian countries. So the region is losing momentum, is facing a challenging international context, but also is facing a challenging situation in terms of the policy maneuvering room. On the fiscal front, we expect Latin America will almost fully revert the impulse provided throughout 2020 and 2021 in the near term. Providing households and firms as much as relief and support was a sensible policy, but these policies have to be reverted in the near term for us to avoid the current scenario to derail from the fiscal sustainability that we are computing for the region. This chart shows the change in the primary deficit in 2020 and the expected change from 2020 to 2022 on the primary deficit, which actually shows that the region has to revert, make a huge effort in terms of the fiscal adjustment. Our view is that, again, the region has to produce a tight fiscal consolidation process, but this tight fiscal consolidation will be very unpopular, and this can, again, very challenging in the political arena. And this takes us back to that political front. The COVID has been detrimental to government's approval ratings across the globe. Net approval rates have dropped significantly across the region, I would say with no exception, which come at odds with the electoral calendar, with elections coming next month in Chile and next year in Colombia and Brazil. The negative approval rates will constrain the capacity of governments to pursue the needed fiscal consolidation across the region. Campaign debates usually bring around the more heterodox economic agenda, in particular in the light of the increasingly competitive left-tilt candidates. The combination of low approval ratings of incumbents and under impressive economic performance suggests a high probability of a political change. This chart shows the net approval rates for several countries running, for several candidates running for re-elections in Brazil. We are taking the measures 15 months prior to the second term elections. And what we're showing here is the net approval of Cardoso, Lula, and Dilma. And what we see is a very high correlation of these measures with the election results that came out for each of their re-electing elections. Extrapolating these results to next year election in Brazil indicates a very challenging scenario for President Bolsonaro. All in, our growth outlook for the region for 2022 highlights the decelerating story in Latin America, in particular relative to EMs. Our baseline scenario stands at 2.4%, slightly above the GDP growth potential for the region, and similar to the consensus forecast. Our baseline scenario for EMs stands at 4.9%. Yet, what this chart highlights is the balance of risk of each of these set of countries. While emerging economies are facing mostly upwards risk, the opposite is true for Latin America. Latin America risks are mostly tilted to the downward. Basically, in the light of many of the factors that we mentioned before, but also in the light of one of the key challenges that many central bankers and domestic regional economies are facing, which is related to inflation. Despite the weak domestic demand, Latin America central banks are hiking policy rates. This dynamic is apparent in Brazil, but also Peru, Chile, and Colombia, where the lack of central bank credibility has quickly caused inflation expectations to the anchor. As we can see in this chart, the 12 months inflation expectations are nearing 8%, way above the central bank's inflation targets. Because the central bank cannot rely on forward guidance as a policy tool, the only way that it can reverse this trend is by acting decisively, cooling the economy, and hoping that the domestic currency appreciates. Obviously, the central bank reaction dents the growth perspective. Back in July, we argued that investors should expect a steeper path of policy rates across the region. We continue to maintain this view, and we will talk later about further details, not only in Brazil, but also for the rest of the region. Now, how this is going to impact inflation? Most professional forecasters expect inflation pressures in LatAm to ease in 2022. For instance, the latest consensus forecast called for a headline inflation for Brazil to fall from 8% to around 4.4% in 2022. We agree with that dynamic. Our modeling work also suggests that inflation will cool down, but we tend to think that the market is undermining inflationary risk. Although there is a 70% chance that inflation will be lower next year relative to this year, elevated inflation expectations, supply chain disruption should keep inflation high in the medium term. And for this reason, we also think or reinforce our view that interest rate will be tightening, or the tightening cycle will be much steeper than the market is currently expecting. So now let me turn to discuss our investment outlook for Latin America. Most of our recommendations are derived from our macro modeling, but also crucially relied on our broad set of models for commodity. We also will touch on this during this part of the presentation. Typically, reflationary regimes in developed markets are extremely beneficial for Latin American assets. To be clear, if we take the sample starting back in 1980s, and we average those periods in which we observe strong global growth, high commodity prices, a weak dollar, and low yields in the US, all those periods are associated with an overperformance of Latin American assets, in particular Latin American stocks. Actually, the excess returns on LatAm stocks average 10% for 12-month holdings. Yet, unlike past recovery phases, LatAm stocks continue to trail the global equity rally, underlying that the underperformance is reflecting many of the domestic factors that we were mentioning above. So to be more clear, let me show you the result on some of our modeling work that aims to identify what are the key drivers of returns in Latin America. So what we do is we do an analysis of the drivers using structural models which identify several of the macro factors that account for the returns in Latin America. What we see is that the positive tailwinds stemming from global commodity upswings, also the weakening of the US, as well as the improved global risk sentiment and expansionary policy, have driven equities upwards. Our modeling actually reveals that if we take out the domestic factors from this accounting, LatAm equities will have gone up nearly 16% in the first half of this year. However, weak domestic fundamentals weighed in heavily on returns, preventing that LatAm assets overperform. So looking ahead, we have this domestic factor weighing in, but also we have an external support that is softening. Although global liquidity conditions should remain favorable, the weakening of activity in China worsens the risk-reward balance for Latin America. On this front, we also have a strong negative call on copper prices. What this chart shows is our latest projection on copper prices. We expect the red metal to fall by at least $500 over the next year, with a 60% chance that prices fall below their current level. This bearish outlook has a large incidence on the risk-reward balance on Chile and Peru stocks, the world's largest producers of copper. In this vein, our recommendations in terms of the currencies are a strong short call on the Peruvian sol and the Chilean peso, for which we see less than 40% chance of a probability of appreciation. We also have a neutral call on the Brazil real and the Mexican peso, for which the appreciation probabilities are more balanced, but we have a long call for the Colombian peso, basically supported by our strong view on the copper prices. All in, both external and domestic factors worsen the upside of new investments. What this chart shows is the probability of LatAm stocks displaying positive real USD returns over the next 12 months. And what you have here is the full time series estimated from our probability models. What we are estimating now is a 52% chance that LatAm stocks yield positive returns. This is a low probability by historical standards, lower than the historical mean that is 57% chance of positive returns. More generally, our models reveal that the ratio of the upside to the downside risk for Latin American stocks is lower than for most regions, which suggests that global investors should underweight LatAm equity portfolios. What this chart shows is the predicted distribution of real USD returns for LatAm. Given that we have the full distribution estimated through our models, we can compute two key measures to estimate the risk-reward balance that allow us to have a more precise estimation of the actual risk relative to, for example, the canonical Sharpe ratio measure. That is, we estimate the expected losses conditional on a loss, which is the darkest shaded area, and the expected gains, again, conditional on positive returns. So the actual measure of risk is related to the lower partial moments. The risk-reward balance is what we call the omega ratio, and it comes out from dividing those measures that I just mentioned. So here we have the full history of the risk-reward balance measured using the omega ratio. What we have here is that the omega ratio stands at 1.2. That means a 20% higher chance of an gain relative to a loss. We have to use some alternative benchmark to compare this measure. And for example, for the S&P, the omega ratio now stands close to 2.5, which is almost double what we see for Latin America. So this allows us to have an overall call for the region, but even so, we see some opportunities stemming from the country analysis. So in order to make that analysis, what I'm going to show now is the risk-reward comparison per country, using or splitting these two components that I just mentioned, the two components of the omega ratio, the upside and the downside risk. Elements closer to the northwest corners display a relatively high upside to the downside risk. The opposite is true for the southeast corner. As a benchmark, again, we're going to plot the risk-reward balance for the S&P, which again had an omega ratio of around 2.5. Regional investors should favor countries we have a relatively low exposure to China, such as Mexico. What you see in this chart is that Mexico has a higher relatively low, upside risk to the downside risk. And in particular, the downside risks are relatively lower than other countries in the region. For example, Brazil, Colombia, and in particular in Peru, which has a wide, high downside risk. So, in relative terms, for regional investor, we recommend to underweight Chile and Peru back on our assessment on domestic and external outlook that we discussed before. We also have a neutral call on Brazil and Colombia, and we have a relatively overweight call in Mexico. Now turning to rates. One crucial question for Latin American investors is whether the recent policy hikes will be enough to contain inflation expectations and the inflation dynamic. In our view, the answer depends on both the inflation outlook, but also the country's fiscal stance, since inconsistencies between the fiscal and the monetary policy can affect both real activity and medium-term inflation expectation. In this context, what we expect for example, Brazil is to keep raising rates in an effort to re-anchor inflation expectations. This chart shows our latest forecast for the Selic. In probability, the Selic should be near 10% by mid-2022. In the medium term, this hawkish stance from the Brazilian Central Bank, we think, will be enough to reduce inflation expectations and to contain the inflation dynamic. In some other countries, this inconsistency between the fiscal and the monetary policies are also evident, in particular in Chile, where they are discussing the fourth early savings withdrawal from the country's private pension system. Having this view on steeper hiking cycles, what we call here is to overweight duration. What this chart shows is the spread between the 10-year and the 1-year local currency sovereign bonds in the region's largest economies. Brazil, Mexico, and Chile's policy tightening has not resulted in equivalent increases in long-term rates. This has caused yields to flatten. We expect this trend to continue, suggesting that investors should favor long-dated bonds over short-term maturities. So, to sum up some of our key convictions, investment calls recommendations for LatAm. You should overweight LatAm equity portfolios in Mexico. We also think that you should go long on durations on LatAm local currency bonds. We are bullish on Colombia's hard currency bonds, expecting that sovereign spreads should narrow, basically supported by our view on crude oil. Related to the commodities, we think that you should be shortening the copper, which also has some consequences on currencies in Chile and Peru. And you should, in particular, underweight Peruvian equities. So now we are going to take some questions from the audience.
Thank you, Federico. We have a few questions from the audience. The first one asks, what's causing inflation in Latin America, and is it caused by the same factors as in developed markets?
Inflation in Latin America has been fueled by some external conditions. Obviously, supply chain factors also is affecting the regions. But what we have to take into consideration when you analyze the dynamic of inflation in Latin America is that pass-through has been increasing in the last couple of years. This is related to the dynamic on the central bank and also explains some of the preemptive response of the central banks in the region. So our outlook, as we mentioned before, is that inflation will start to behave in the medium term, but short-term dynamic is going to be influenced by high inflationary risks.
Thank you. And the next one asks, how do you expect Fed policy to affect returns in the region?
So related to the Fed policy, we have a global view on the Fed hiking and the removal on the liquidity support. Basically, our view is that the full tightening cycle remains unlikely. This view is based on our analysis and our modeling, but also in the perspective from the 2013-2014 tapering cycle. Basically, our forecast points to a single policy rate hike over the next year with a 1 in 10 chance of multiple hikes in this period. So a very low probability of that event happening. For the region, implied further softening of the external condition that we mentioned before will negatively weigh on the equity performance. Just to make clear, this scenario that we are pricing in the global context is priced in our predicted distribution that we showed before. Basically, the real USD equity returns for LatAm are consistent with this view, and the high downside risk that we calculate basically reflect this softening of the external condition that we are seeing in the medium term.
Okay, thank you. And thank you all for tuning into this month's webcast. As mentioned at the beginning of the session, we have a copy of the slide deck we'll share with you later today. We'd also like to offer you a one-on-one meeting with a senior member of our research team so that you can ask questions and get to know our research process better. Thank you again for your time, and we hope to see you at next month's webcast, which will focus on China and commodity markets.